There are two stages in the life of an investor. Building a nest egg so that you achieve financial freedom. And second, being able to retain the nest egg and live off the nest egg. I am living the second experience, having gone through the first one. So from the ages of 24 to 54, I worked in the corporate world and built a nest egg that was adequate for me to live on. And then for the last 11 years, since the age of 54, I have been able to generate enough wealth to pay my bills and do the things that I want to do. Hello, my name is Skip Kapoor. This is my new channel, Passive Income from Equities. I intend to share the journey that I made and the portfolio, both during my working years, during my initial retirement, and the slight change in strategy that I was able to make because of new products that generate much more income from equities that have occurred over the last couple of years. Here are the topics I intend to cover in the presentation. At the beginning, I want to make sure that I have covered some of the most basic definitions. I don't want to assume any knowledge on the part of the viewer. And so it's kind of important that you understand the difference between tax deferred accounts and taxable accounts. So I'll definitely want to describe that. And then I also want to just talk about the different types of investors. What is an investor versus, say, a trader? The huge difference. What is a passive investor versus an active investor? And a passive investor, very briefly, is buying indexes. What's a dividend growth investor? That's part of the strategy that I have always used, even from the very beginning. And then what do I mean by an enhanced equity income investor, which is the strategy that I'm using in the second stage of my investing career, the living off wealth stage, as in contrast to the first stage, which was building wealth, and where my emphasis was much more as a passive investor and dividend growth investor. I'll also address compounding. Understanding compounding is crucial for a couple of reasons. One, if you understand it, you'll be able to play the long game. You'll understand how $1 becomes 16 or 32. And you will have the stomach to deal with the vicissitudes of volatility. Volatility is the price you pay for investing in equities. And if you understand how compounding works, you'll be able to outlast the short-term inevitable pain that will come along the way. I also want to address the 60-40 portfolio. So even though I've been a 100% equity investor from the very first time I invested in the marketplace, now coming close to 44 years, the 60-40 portfolio is what a professional advisor would recommend. It is also what very highly respected investors, leaders in this space like Jack Bogle and others would recommend. And the 60 stands for equities, typically international and US, and 40% stands for bonds. So it's a 60-40 equity to bond portfolio. And what I wanted to show as a matter of intellectual integrity is that it is a viable strategy. There's a cost you pay for it and a benefit you get, and I want to make sure that that's visible. The next thing is there are two indexes in particular that every investor must understand, the S&P 500 and the NASDAQ 100. So I'm going to cover those, and I'll also cover SCHD and the Dow Jones US Dividend 100 index behind it, which I consider to be very well designed. So those three indexes will be addressed so that you have the, for lack of a better description, the intellectual underpinnings for making sound decisions and why most of my investments are based on those three indexes. Most importantly, I will cover my investor journey, exactly what I did during the building wealth stage of my investing career from the ages of 24 to 54, and then what I've done in terms of living off my nest egg, and that in that phase there have been two parts, one from the age of 54 to probably 61, 62, and then I made modifications to the strategy because of newer, more innovative, more tax efficient products that have come into the marketplace. And then lastly, I will address what I mean by being an enhanced equity income investor and why I'm a committed EEI investor. Let's talk about the different types of investment accounts so that we have complete clarity. One type of tax deferred account are what most people have during the working years, which is the 401k that you get at work, and many people open up what's called a traditional IRA. So the basics of this are relatively simple. They're funded by monies on which you have not paid income taxes. So when you fund a 401k or an IRA, it tends to immediately lower your reported income and your taxes. And you will not pay any taxes on capital gains or dividends until you withdraw funds, typically at 59.5 or later. So if you withdraw before 59.5, you, in addition to paying a tax, you also pay a penalty. After 59.5, you simply add the money that you take out from these tax deferred accounts and add them to your income at that point in time. During my working years, I maxed the 401k and always funded a traditional IRA. Another type of tax deferred accounts are Roth, based on the concept of Roth. There are Roth 401ks and Roth IRAs. These are funded by monies on which you have paid income taxes. So that's one big difference between a Roth IRA and a Roth and a traditional IRA, or a Roth 401k and a traditional 401k. Here what happens is that you have paid taxes, and you will not, just like a 401k, a traditional 401k, you will not pay any taxes on capital gains or dividends, but you will never pay it even after the age of 59.5. So you can withdraw it after 59.5 and never pay a penny in income tax. And the reason is that you've paid the taxes upfront. If you withdraw any funds before the age of 59.5, just like in a regular 401k, you will pay a penalty. I did not have the option during my working years of having a Roth 401k, but I did fund the Roth IRA. And lastly, you can have accounts which are taxable, which are called taxable accounts, outside of your 401k and IRAs. These obviously are funded by monies on which you have paid income taxes. And you typically open these accounts with firms like Schwab, Fidelity, Vanguard. There are probably literally maybe 50 to 150 viable options in terms of firms. I use Schwab personally. These accounts will be funded with after-tax funds. This is monies that you have paid taxes on, and you have spent whatever you need to on your normal expenses. You have money left over. That is what you're using to fund these taxable brokerage accounts. And you will pay tax on capital gains, dividends, and any other income generated by these investments annually. You will add whatever capital gains and dividends that you have to your W-2 income during your working years and pay taxes on this. So from a tax perspective, it's probably the most inefficient, but that doesn't mean that you don't open a taxable brokerage account. In fact, I think it's essential in order to achieve wealth that you have all three of these types of accounts. Let's now address the many types of equity investing. When we use the word stock market investing, equity investing, people look at it only through the prism and the experience that they have. And I want to just make sure that it's very clear that there are a myriad of choices and styles in play. And it's kind of essential to understand some of the larger differences. So for example, one style is momentum, that is buying a company simply because its price is going up. Another style would be called value, buying a company because its price is cheap relative to earnings in your view. Yet another one is growth, that is purchasing a company because its earnings are going up fast. Yet another one would be what's called quality, and you will have ETFs and mutual funds based on what are called quality factors. They will use things like, or aspects of performance like revenue growth, return on equity, which is a measure of management efficiency, margins, which are a measure of profitability, free cash flow to debt, which is a measure of the mature companies typically that are throwing off enormous amounts of cash. So they'll combine some of these factors and create a fund, or as an individual investor, you buy companies that go through these screens that you have created. Yet another style is dividend, buying a company because it pays dividends, high dividends, medium dividends, low dividends. There's a style called covered call, where you own a stock and then sell call options on it to generate income. That's a strategy. There is enhanced income variations on that are different from covered call, where you own the stock and you might sell a call spread. For example, like a new fund that I like, new ETF that I like called SPYT. Or you can buy dividend futures. Yeah, there's a fund called QDPL that does that, which I'll explain later, which I like. There are strategies like going short volatility, like SWOL does. So there are variations for generating income from equities that are different from covered calls. Dividend growth is different from dividend. Here you buy a company or a set of companies not just because they're paying dividends, but because the dividends have been increased for some number of years, 5, 10, 20, 25. If they have been increased for 25 years plus, the jargon is that they are called dividend aristocrats, right? So the things in green are the heart of my strategy. So most of my holdings today are either covered call based, or they're either enhanced income variations or dividend growth. Yet another type of investing is simply owning the market, where you own an index, where you can own the entire market, 3,000 plus shares, or you can own a subset of it, the S&P 500, which is very common, which is the benchmark I use, the Dow Jones 30, NASDAQ 100, and so on. And there are ETFs for each of the styles above. And one of the conclusions I've come to over the last 2 to 3 years is that I'm moving away from individual stocks to where they're only like 10% of my portfolio, and more towards ETFs. And here's another fun fact. There are more indexes than there are stocks in the US, and that change occurred like more than 6-7 years ago. So there are so many different strategies, cuts of the market, if you will, that there is an ETF for almost any strategy that you can think of. As you begin to start your investment journey or modify your investment journey, it is very important that you decide which game you are going to play in. And there are at least 3 viable options. In my view, one of them is not viable, but in the interest of not trying to tip the scales, I'll consider all of them viable. And you must understand the pros and cons of each of these 3, so that when you do decide on a strategy, you'll actually stick with it. So one aspect is what I'm going to call gambling. And this is where you engage in short-term trading. You buy naked options, sell naked options, you borrow money on margin from your brokerage. And typically what happens in this, the pro is that if you have a system and it works, you can generate enormous returns, because you are having to put much less, you have leverage. You're putting in much less capital on an option than having to actually buy the underlying assets. The difficulty, the con of this approach, and why most individual investors end up losing assets when they try this approach, is you don't possess any unique knowledge that the market doesn't have. And number one, and number two, the people on the other side of option trading and things like that are typically large institutions with vast resources and knowledge. So that's one option. The second option is what's called speculation. Here, what you do is you engage in long-term stock picking. This is something I personally have been engaged in for the last 40 plus years, moving away from it as quickly as I can. Only 10% of my portfolio right now is individual stocks. The pro of it is that it can lead to spectacular results if you get even one right. You get one Amazon or Nvidia or something like that, and it can make up for several mistakes. The reason odds are low in this is because studies, especially the one that Henrik Bessenbinder from Arizona State University, is a very famous study that every investor should understand, and I will address it in great detail in a subsequent presentation. What his data shows is that only 4% of stocks generate all the returns of the market. And then I think something like 58% or something like that barely beat T-bills, and 38% or something like that actually provide lower returns than you would get on very short-term T-bills or treasuries. So this is a endeavor, I would say, where the odds are against you. A third option is what I'm going to call investing, where you buy and hold broad-based funds and you pay attention to fees and you pay the lowest fees possible. And then you mix and match funds based on your risk tolerance. If you are like me and can deal with volatility, you have 100% equities. If you want less volatility, you mix things like bonds and so on and so forth. It's a slow and steady, very boring approach. This is not an approach where people will gather around you at a party where you get to say, well, gee, I've held S&P for 25 years, and the crowd will rapidly dissipate versus I bought Nvidia and it went up 1700%. Odds are very much in your favor, and I'll show you the data in a little bit, when you hold indexes greater than for periods of 5 years. In my view, the data is very convincing. If you put money in equity markets for a period of less than 5 years, that's not a good idea. So if it's less than 5 years, I would put it in short-term instruments, things like that. I would only put long-term money, which in my language is 5 years plus, into the equity market. Lastly, I'm going to use Warren Buffett's definition of an asset, which is it produces something of value and generates income. By that definition, pure stores of value like gold, etc., would not be considered an asset. I don't want to get into like a debate and a fight about it, but to me, words should have meaning, and that's what asset means to me, and it's the basis for my decisions related to my investments. As you make a decision on deciding your game between, speculation, gambling, being an investor, you have to understand that's a key framework decision, right? So what they call the three major decisions of your life, the most important ones, like who you're with, where you live, what work you do, these decisions you have made based on some framework. Some of us outsource these decisions. We'll say, oh, my parents or somebody else can decide who I'm going to marry. Some of us say, nope, we're going to choose our own partners. So these are framework decisions. There's no right and wrong. It just depends on your worldview. So what are the factors when it comes to making your framework decision for investing? There are 2 or 3 things I would ask you to consider. And again, please understand, there's no value judgment. I'm just giving you some things to think about. So one fork in the road is an abundance mindset versus a scarcity mindset. So if a friend or a brother or somebody else that you know has a success, is your feeling one of happiness for them or one of envy and why didn't it happen to me, right? So that's the difference between abundance mindset and scarcity mindset. Another uh, fork in the road is accountability versus excuses. When something goes wrong in your life, do you look at it and say, what could I have done better? Or do you make excuses for your poor performance or whatever went wrong? And lastly, the difference between playing the long game and wanting instant results. Wanting instant results is, I'm only going to hit homers. I will never have setbacks. Everything is going to be perfect. Playing the long game is, having a long-term vision, having a clear strategy, understanding that you're going to have to adjust tactics along the way, and that there will be setbacks, and taking course corrections as appropriate. So these are the types of things that you need to think through as you make your framework decision as an investor. In my case, my decision is rather clear, and the older and more experience I get more committed to it. I am an investor. I would rather be certain of a good return than hopeful of a great one. I'm willing to be boring and get my 8 to 12% over the long run on average and deal with the inevitable and large volatility along the way. So as Buffett says, most investors are better off putting their money in low cost index funds. Ben Graham, who basically wrote the book on investing, said individuals who cannot master their emotions are ill suited to profit from the investment process. And by that he was talking about people who can't deal with volatility. They want the returns that come from equities, and equity returns tend to be the highest of all uh, asset classes, but they don't want the volatility that comes with it. And so therefore they're always buying high and selling low. Buffett, Seth Klarman, Monish Pabrai, by the way, all of them are worth listening to. One of the things that Buffett in particular has said is that investing is about the only activity where an amateur can beat professionals. In no other endeavor, whether it's brain surgery, flying a plane, playing tennis, etc., is it more advantageous to be an amateur and not a professional, except in the case of investing. Because it turns out that when you own broad indexes, you actually can beat most professional investors. It's something people don't understand and they don't stick with it, and so they give away a tremendous advantage. What you're doing when you own the market is competing on the basis of time. In a subsequent slide, I'll explain to you what I mean by that. But the longer you hold on, the higher the odds that you will be successful. And as Jack Bogle, the key person behind Vanguard, the key person behind the index, the S&P 500 index in particular, said, don't look for the needle in the haystack, just buy the haystack. In that way, you will own the 4% of companies that are going to generate 99% plus of the wealth. And these 4% of the companies are not the same companies year after year after year. They keep changing. But because you own the index, you're always owning them. So lastly, this is a mindset. Boring and consistent and sure over exciting and inconsistent and with very vague outcomes. Those are the two alternatives.